Imagine this. You're walking down the street on a sunny afternoon, craving a refreshing cold drink. You stroll into your local convenience store and there it is, your favorite soda. You know the price. It's been the same for months. You grab the can, head to the counter, and hand over your cash. The cashier rings it up and whoa! The price has jumped. It's now $1 more than last week. You stand there, a little stunned. What just happened? That extra dollar wasn't part of your plan. That's inflation at work. Inflation is a hidden thief. It steals from your wallet, from your savings, and from your purchasing power. But the worst part is, it doesn't need to break into your house. It simply sneaks into your everyday life, making everything a little bit more expensive without you even noticing it at first. So let's break this down with an example you can probably relate to. Think back a few years. How much did a pack of gum cost? Maybe 50 cents? Now, it's closer to $1. Same gum, same taste, but the price has gone up. Inflation happens when the general price level of goods and services rises over time, meaning your money doesn't stretch as far as it used to. That 50-cent gum now costs you $1 and your $20 bill doesn't buy as much as it did last year. Now let's make this even clearer. Imagine you have $1,000 saved up. In a world without inflation, that $1,000 should still be able to buy the same amount of stuff in the future as it can today. But in an inflationary world, your $1,000 starts to lose value. Let's say inflation is 3% this year. That means your $1,000 can only buy what $970 could have bought last year. So the same things you were planning to buy with your savings, well, now you'll need more money to buy them. Now, you might be thinking, okay, but 3% doesn't sound like much. And you're right, it doesn't sound like a huge deal at first, but let's break it down over time. Let's imagine inflation sticks around at 3% for the next 10 years. That $1,000 you saved up today would only be worth about $740 in 10 years, buying 26% less than it does right now. Over a decade, the value of your savings has been chipped away. Let's make this real. You're saving for something big. A new laptop. Today, you know the model you want, costs $1,000. You're planning to buy it in 2 years. But if inflation continues at 3%, in 2 years that same laptop will cost about $1,060. So your $1,000 doesn't quite cut it anymore. You'll need to find an extra $60. Over time, that small increase in prices adds up. And here's another kicker. Inflation doesn't just hit big purchases. It affects everything. The cost of groceries, gas for your car, even that simple lunch you grab during the workday. Take the price of eggs, for example. A carton of eggs that cost $1 5 years ago might now cost $2 or more. It's still the same eggs, but the price has doubled. That's inflation's effect on your daily life. But why does inflation even happen? Well, there are a few reasons. Let's take a look at the most common ones. First, there's demand-pull inflation. This happens when demand for goods and services outpaces supply. Think about it. If everyone suddenly wants a new iPhone, but there's only a limited number of phones available, the price will go up because demand is higher than supply. It's basic economics. Then there's cost-push inflation. This happens when it becomes more expensive to make things. For example, if the cost of oil rises, it becomes more expensive to produce and transport goods. Companies then pass those increased costs on to consumers, raising prices across the board. Finally, there's built-in inflation. This one is like a feedback loop. Workers demand higher wages because they're feeling the pinch from rising prices. Employers, in turn, raise prices to cover the higher wages they're paying. It's a vicious cycle. But don't worry, inflation isn't all bad. A little inflation can actually be a sign of a healthy economy. It's when inflation gets too high that things get tricky, and the cost of living becomes harder to manage. So, how do you protect yourself from inflation? Here's a couple of ideas. First, invest. Keeping your money in a savings account is safe, but it's not growing fast enough to outpace inflation. You need to look at investments like stocks, bonds, or real estate. Over time, these assets tend to grow faster than inflation, helping you keep up with rising prices. Second, plan for the future. Inflation affects long-term goals like retirement. If you're saving for the long haul, make sure you're considering inflation in your calculations. Your retirement fund should grow at a rate that outpaces inflation, so your savings don't lose value over time. Third, reduce debt. When inflation rises, so do interest rates. So if you're carrying debt with a variable interest rate, it could become more expensive as inflation increases. Paying off debt helps you avoid paying more in interest as inflation pushes up borrowing costs. And finally, spend wisely. Inflation affects your day-to-day purchases. If you can buy things in bulk or lock in prices now for things you'll need later, like groceries or fuel, you can shield yourself from future price hikes. To wrap it up, inflation is a sneaky thief that's stealing the value of your money. It quietly raises the price of things you buy every day and slowly erodes the value of your savings. But if you understand how it works, you can take steps to protect yourself. Whether it's investing, planning ahead, or reducing debt, being proactive is key to beating inflation at its own game. So next time you find yourself at the store looking at that $1 soda, you'll know exactly why it costs more than last week. Inflation might be stealing from you, but with a little knowledge and preparation, you can take control and make sure it doesn't take everything.